If Iran were to collapse tomorrow, most people would think of protests, conflict, or a new government being installed. But for someone who has worked in macro finance for many years, the first thing I see is not political imagery, but the paralysis of national cash flow. Because in every regime change that has occurred over the past 8 decades, from Iraq in 2003 to Libya in 2011, or Afghanistan after 20 years of military presence, failure did not stem from a lack of military power, but from a misunderstanding of the economic structure of the intervened nation. In Western economies, governments exist through taxation, meaning wealth is created by millions of businesses and individuals before flowing up into the budget, forming a decentralized power system in which the state depends on society to function. If citizens stop producing, the budget is depleted and the government is forced to adjust. However, in resource-based countries such as Iraq before 2003 or Iran today, the structure is completely reversed because the state does not need its people to generate its primary revenue, but only needs to control oil, gas, and strategic resources, thereby directly extracting money from the ground into the treasury and then redistributing it back to society through civil servant salaries, fuel subsidies, food, defense, and infrastructure. This model is called by economists a rentier state, meaning a state that rents out resources where power does not lie in the productive capacity of the population, but in access to and control over resource-based cash flow. When you change leadership in a tax-based economy, the administrative apparatus, business system, and market structure continue to operate because they do not depend entirely on a single distribution center. But when you remove the government in a rentier state, you are not merely replacing a leader, but inadvertently pulling out the pivot of the entire national accounting system, causing military salaries, public budgets, domestic credit, and budget-dependent supply chains to halt almost immediately. The lesson from Iraq demonstrates this clearly when hundreds of thousands of soldiers and civil servants lost their income after a single decision to dissolve the old apparatus, and in an environment where private economic opportunities were not developed enough to absorb that workforce, military and organizational skills were quickly redirected into new power structures, creating a spiral of instability that lasted for many years. What financial markets observe is not democratic slogans or symbolic shifts in power, but a simple yet ruthless question: will national cash flow continue? Because when a resource-based economy experiences a breakdown in its distribution mechanism, the shock does not stop at politics, but spreads to the budget, exchange rate, banking system, and ultimately the global commodity market. Therefore, if we look at Iran not through an ideological lens, but through a financial structure, we will see that the risk does not lie in who replaces the leadership, but in whether the rentier mechanism is disrupted and drags with it the interruption of one of the world's largest energy links, and that is the true starting point of a story that could directly affect inflation, interest rates, and the investment portfolios of millions of people worldwide. Part 1. Iran, the central link of the global energy market. If in the previous section we discussed the internal cash flow structure of a resource-based nation, then in this section we must widen the lens to a global scale. Because Iran is not only a domestic rentier economy, but also a strategic link in the world energy system. And this is precisely what makes any regime change scenario highly sensitive to financial markets. Iran possesses the third largest oil reserves in the world and sits adjacent to the Strait of Hormuz, through which approximately 1/5 of globally traded crude oil passes each day. This means that any disruption in this area, even if it lasts only a few weeks, has the potential to create an immediate supply shock, pushing oil prices sharply higher before adjustment mechanisms such as strategic reserves or production reallocation have time to take effect. Energy markets operate more on expectations than on physical reality. So even a rise in perceived risk will have geopolitical premiums directly added to futures prices, with consequences that quickly spread to transportation costs, industrial production, and ultimately the consumer price index. For central banks currently in an inflation control cycle, particularly the United States Federal Reserve, an oil shock could force them to delay monetary policy easing, thereby keeping interest rates higher for longer than expected, putting pressure on stock markets that are priced based on anticipated rate cuts. This is a point many investors tend to underestimate. Energy is not merely a commodity. It is the cost foundation of the entire economic system. Therefore, volatility in Iran does not stop in the Middle East, but can be reflected in bond yields, the strength of the United States dollar, and global capital flows within just a few trading sessions. In addition, Iran does not exist in isolation, but is embedded in a strategic network with Russia and China. China is the world's largest energy consumer and has a direct interest in maintaining stable supply, while Russia has its own incentives in managing oil markets to optimize budget revenues. Therefore, any turbulence in Iran can trigger chain reactions in diplomacy, military affairs, and trade, increasing market uncertainty. When uncertainty rises, global capital tends to move towards safe haven assets such as gold and United States government bonds, while emerging markets face capital outflows, weakening local currencies, and rising borrowing costs. In summary, Iran is not merely a political story, but a crossroads of energy, currency, and economic power. And in a world where growth depends on low capital costs and controlled inflation, any disruption at this link could alter market trajectories far faster than the average investor imagines. Part 2. 4 global financial scenarios if Iran collapses. If we view the issue from an investment perspective rather than a political one, then the most important question is not whether Iran will experience regime change, but which scenario the market will price in and how quickly the adjustment will unfold. Because in finance, probability and expectations are what determine capital flows. Fundamentally, there are 4 major scenarios that investors must consider, and each scenario implies a completely different asset pricing structure. The first scenario, attractive in theory but with a low probability, is a rapid and relatively stable transfer of power, in which a new government reintegrates into the global economic system. Sanctions are eased, and Iranian oil production returns to the market at a larger scale. If this occurs, increased supply would create downward pressure on oil prices in the medium term. Inflation would cool faster than expected. Long-term bond yields could decline, and equity markets, particularly growth sectors, would benefit from expectations of lower capital costs. However, history shows that power transitions in resource-dependent economies rarely unfold smoothly. Therefore, the second scenario, internal fragmentation and prolonged instability, carries a higher probability, and this is the scenario markets fear most oil and gas infrastructure becomes disrupted. Competing factions vie for control of revenue streams. Export volumes fluctuate unpredictably, causing sharp oil price volatility and geopolitical risk premiums to be added to every traded barrel. The direct consequence is that inflation could reaccelerate even without an increase in global demand, forcing central banks to maintain tight monetary policy for longer, thereby putting pressure on equity valuations and real estate markets. The third scenario involves expanded proxy conflict, in which regional or global powers engage indirectly to protect their interests, prolonging uncertainty for many years. This environment would normalize high market volatility, with capital continuously rotating between risk assets and defensive assets, and sectors such as energy, defense, and basic commodities being repriced, while sectors sensitive to capital costs, such as growth technology, face pressure. The fourth scenario is more systemic and less discussed, but carries the greatest long-term impact, namely the spillover effect on nuclear security when other nations conclude that lacking strategic deterrence capability may leave them more vulnerable to intervention. If this trend accelerates, geopolitical risk would be permanently repriced into markets, implying structurally higher global capital costs and compressed corporate profit margins over an extended period. The key point here is that each scenario does not merely change oil prices, but also alters inflation expectations. The yield curve, the strength of the United States dollar, and investor risk appetite. Therefore, the question is not which scenario we prefer, but which scenario the market is quietly betting on, and whether we are underestimating the level of structural risk that could emerge from a shock at one of the world's most critical energy links. Part 3. What should investors prepare? If the previous sections focused on structural analysis and scenarios, then this final section forces us to return to the most practical question for any investor in an environment where geopolitical risk can translate into financial volatility within just a few trading sessions. What should we do to avoid being swept away by emotion while still protecting our portfolios? The first thing to understand is that markets do not collapse because of news, but because of mispriced risk. And the most dangerous condition is always complacency when everything appears calm. If Iran enters a period of instability, early warning signals will not be found in diplomatic statements, but in the price of Brent crude, in the VIX volatility index, in United States Treasury yields, and in the strength of the United States dollar, because those are the places where capital reacts before the media has time to explain. A prolonged oil shock could halt the disinflation trend, forcing central banks to keep interest rates higher than expected. And when capital costs do not decline as anticipated, growth stocks priced on distant future cash flows will face pressure first. Conversely, energy, mining, defense companies, and defensive assets such as gold may be repriced higher because they serve as natural hedges against instability. However, a prudent strategy is not to make extreme bets on a single scenario, but to build a resilient portfolio structure in which the weight of risk assets is balanced with defensive instruments. Liquidity is maintained at a level sufficient to seize opportunities during sharp market corrections. And above all, discipline is preserved by responding not to short-term headlines, but to genuine shifts in macroeconomic variables. History shows that geopolitical shocks often create intense short-term volatility, but do not always destroy long-term growth foundations. Therefore, what distinguishes professional investors from the crowd is not the ability to predict the future precisely, but the ability to manage risk when the future does not unfold as expected. Ultimately, the story of Iran is not merely a Middle Eastern story, but a test of how we understand the link between energy, inflation, interest rates, and asset valuation. And if you observe markets long enough, you will recognize that in every major cycle, those who remain composed as uncertainty rises are the ones who capture opportunity when risk is repriced. Before we end this video, I want you to consider something. If tomorrow oil prices were to rise by 30% within just a few weeks because of a geopolitical shock, how would your investment portfolio respond? Are you truly prepared for systemic risk? Or are you betting that things will not go that far? Markets do not reward blind optimism or extreme pessimism. They reward those who understand structure and manage probability. So in your view, If Iran experiences major instability, which scenario is most likely rapid stabilization, prolonged chaos, or a proxy conflict that shakes the global energy market? Leave your perspective in the comments below. I genuinely want to read how you assess this risk and how you protect your capital. If this video helped you see geopolitics through a financial lens rather than an emotional one, press like so I know you want more in-depth analysis like this. And do not forget to subscribe so you do not miss the upcoming videos where we continue to unpack the biggest risks quietly shaping global markets.